Hello, everybody. This is Ted Bauman and Clint Lee with your Money Matters Monday video from the Bauman Daily. We've got some news, really, that's not so good for the economy from last week, and it's not about COVID-19. This time it's about a resurgence of the US-China trade war. Now, whatever the reasons are behind it, and I think most people would acknowledge that it's largely political at this stage, it's not good for a stock market that is struggling to maintain its momentum. We've seen large business CEOs, some of the most important in the Dow, saying that a V-shaped recovery is out of the question and they're not planning for it. We've seen some of the most successful hedge fund managers in the country saying stocks are wildly overvalued. So this is the last thing we want to see in this kind of an environment. Now, Clint, we talked about this earlier today, and you spoke about the nature of the recent upsurge, the specific types of companies that have been driving it, and this is not good news for them. So tell us what your thoughts are on this.
Yeah, sure. So, this latest chapter of the trade war is focused squarely on the technology sector, and a couple reasons why that's so important right here. One is that because the technology sector has been responsible for really propping up the market. Returns in the market overall would be much worse if it wasn't for the tech sector. And I'll pull up a chart here to highlight the point I'm making. This shows year-to-date tech sector stocks as illustrated by the ETF XLK relative to the S&P 500. You can see XLK is up about 0.5% or so year-to-date. S&P, meanwhile, down about 12%. Tech sector stocks make up about 25% of the S&P 500. So if it wasn't for this performance out of the tech sector, performance of the S&P would be much worse than what it is already. And there's another point to make. One of the reasons why you've seen tech stocks hold up relative to the overall market has to do simply with earnings. They're expected to do much better relatively speaking on their earnings estimates. And that's what this next chart shows here that I have for you. This shows currently what the earnings estimates are for 2020 for all the S&P 500 sectors. And while the S&P 500 is expected to be down about 22 or 23% on earnings growth for this year, you can see I've highlighted tech sector at the top, trailing only utilities. So another important aspect is that tech sector earnings are helping to prop up the markets overall. That 23% decline would be much worse if the tech sector starts to get, especially if it starts to get hit here because of the trade war.
Well, it certainly seems to be getting hit. We're recording this on Friday, and already we can see that there's a lot of negative sentiment on the tech sector. But let's stop for a second and disaggregate what we mean by technology. The tech sector, when we talk about it in the US, I think we tend to kind of assume that we're talking about the big, trillion-dollar market cap companies like the Amazons and the Googles and all those kinds of companies, and Facebooks and Apples. Now, to a certain extent, some of those companies are involved in physical stuff. Amazon sells physical stuff, and so does Apple. But increasingly, these companies are really providing services with technology, right? Their business models are based on providing technological services that people can use. Facebook, you talk to other people, you share things. On Amazon, you access a marketplace. Apple is moving rapidly into service, television, Apple Radio, all that kind of stuff. So that's one kind of technology. But is that what we're looking at when we talk about is there a threat to that kind of technology, do you think?
No, when you look at the underlying performance, especially today, a lot of these headlines coming out on this latest chapter of the trade war are relatively new. As you mentioned, it's Friday as we're recording this. What it's come down to is that the Trump administration is trying to block shipments of electronic components to Huawei. Mm-hmm. And we expect, obviously some sort of retaliation out of China from that. But when you look at what types of technology they're trying to block, it comes down to the actual components. It's more things that are being manufactured by the tech sector, as opposed to what you're highlighting on the services aspect.
Right, and I think that's a critical distinction because, the big drivers of stock market gains in the tech sector have been these service-oriented companies like Netflix and Microsoft. Sure, if they lose access to the Chinese market, that's going to hit them. But that's not the only thing that they do. They have a huge footprint, these tech companies, all over the world, not just in China. And in fact, in some cases, like with Alphabet and Apple, China is not a major contributor to their global revenues because the Chinese have kind of pushed back and tried to help them. I mean, Google can't run a search engine. So in that sense, as an aside, it's kind of rich for the for the Chinese now to be complaining about this when they've been doing this all along. But that does lead, I think, to an important consideration, and that is that people are panicking about tech, but they're panicking about the wrong things. What really is going on here is we're talking about a reorientation of global supply chains for things that go into physical technology, microchips, switches, fiber optical components, all the stuff that's going to go into the 5G revolution. And that is where the action is. And yes, we've seen those stocks down today. I want to show you a chart that shows the S&P 500 over the last 5 trading sessions versus SMH, which is a popular semiconductor ETF. I mean, you can see that it was a little bit below the S&P. It peaked above it yesterday, Thursday afternoon's trading, and today it's way down. And that reflects people taking this news and panicking. But the fact is that if we are going to be reorienting supply chains, aren't we going to need these kind of components? The fact that the Chinese may retaliate doesn't stop the fact that lots of businesses are going to need lots and lots of microchips. We're going to need semiconductors of all kinds if supply chains are going to be reoriented. I know you have some thoughts on this. Tell us where the opportunities begin.
Yeah, I mean, first off, to highlight what you're just talking about there, I mean, this is something that the administration's been pushing for ever since the original trade war erupted a couple years ago, was to try to bring supply chains back domestically. So this is something that's already been ongoing, and then the impact of the pandemic, highlighting the weak links that we have in the global supply chain, is just another reason why to consider, start to bring that manufacturing back domestically to ensure continuity when the unexpected hits. And absolutely, that's creating opportunities for all sorts of companies, but especially ones that are involved in robotics and automation. Because when you look at a lot of the companies that have been sending their supply chains offshore, they're looking for a cost edge. It's because it costs a lot to manufacture. They have high margins, but it costs a lot to manufacture their products. Mm-hmm. And so because of that, one way to try to limit the cost while bringing that manufacturing back domestically is to start to increase the use of robotics and automation in that process. And you have ETFs like ticker ROBO, that track companies that produce and supply into that automation theme.
Right. And I think this is an important distinction to make, and this is precisely why it's so important, I think, to disaggregate the tech sector. I mean, a couple of years ago, I was reading about Whirlpool and how they were thinking about bringing manufacturing of some of their basic appliances back to the United States. And it wasn't because of trade war. This is all before that started. Their rationale was that Chinese labor costs were increasing. And when you add in the difficulties of operating a global supply chain, they thought, well, it's getting to the point where with robotics, we can actually build this stuff ourselves by limiting labor costs, by using automation. We can do it. I think they were talking about Kentucky, maybe they were going to put up a new plant. I haven't followed that specific one, but that's been the case, that a lot of these US companies are saying, hey, China's great, but China's also starting to get expensive. It's moving towards a service economy. Wages are increasing, so maybe it makes sense to bring stuff back here. And to me, that illustrates a critical point. It's not the washing machines that we're thinking about. Onshoring production of washing machines is not a big deal. What's a really big deal is onshoring productions of the components that go into those robotics, things like microchips. I mean, these robotic things depend on very, very advanced microchip technology that is not easy to produce. And it requires a lot of investment. It requires a lot of capital expenditure. And on that score, let's talk a bit about what's happening there. We just heard news that Taiwan Semiconductor Manufacturing, which is the world's leading chip foundry that makes microchips, is actually going to open a plant in Arizona. What are the implications of that for U.S. supply chains and for the semiconductor sector broadly?
The announcement pertains to their manufacturing process around some of their smaller chips, the 5 nanometer size, and that represents sort of the cutting edge of technology of chips that are either more powerful or more energy efficient, or a combination of both. And that's what's going into the most advanced technology, things like 5G base stations that will enable 5G networks, or the next generation of Apple smartphones. So yeah, I mean, we're seeing that shift, in terms of that high tech piece of the supply chain that's starting to come back here, and because of that, to manufacture that requires the most advanced equipment,
Right.
and there's stocks within that SMH ETF that you were highlighting earlier that produce the type of equipment that Taiwan Semiconductor is going to need in building out this plant. I think this facility in total is going to cost about $12 billion. Right. That's in question.
And this is precisely why we're doing this video, to disaggregate this for our viewers, that the companies that manufacture the things that semiconductor foundries need, that they're not making metal presses, folks. They're not using stamping out panels for automobiles. We're talking about the highest tech manufacturing equipment there is to produce extremely low or high tolerance, rather, manufactured goods like microchips. And almost all of the major companies that do this are American. They actually are based here in the United States, or have been capitalized here in the United States. And so this is why it's so important to disaggregate this stuff below the headlines. That's where the opportunity is going to come from. And on that score, I think it's important to recognize that this is not just about the White House, in a sense, trying to create a diversion from the whole COVID issue by getting angry with China. The Europeans are not happy with China right now because of the way they've behaved in the aftermath of the COVID-19 outbreak. The people say that they're bullying their governments, and they're threatening to withhold trade stuff. That they're doing themselves no favors. And so whether or not we have a Republican or a Democrat in the White House at this point doesn't really matter. This is going to happen. It's already happening. And it's happening largely because of the behavior of the Chinese, to be honest about it, but also because of a recognition of the real risks of global supply chains, not just for things like medicines and masks, but for the very basic stuff that underlies the current technology economy. And I think once that starts to happen, then you will see a tremendous boom in those specific companies, what we like to call pick and shovel companies, that make the stuff that allows these factories to operate on US soil. So Clint, you've mentioned Robo. There are some other stocks out there that we're looking at for the Bauman letter, and our Alpha Stock Alert, our specialized trading service. And if you're interested in learning more about those, subscribe, because that's why we're here. We want to give you an opportunity to understand what it is we're thinking, so we can share those ideas with you. Clint, I think this has really been an interesting discussion, because the news today on Friday makes it seem as though it's the end of the world for tech. What we're saying is this is just the beginning of an opportunity that most people haven't even realized. So anyway, it's good to talk to you again. That's it for this week. Remember, you can subscribe to the Bauman letter by going onto our website and considering the offers there, and also subscribe to our YouTube channel itself. So make sure you always get notifications of when we've got a new video coming out. So that's it for us this week. Make sure you pay attention, I think, to what's happening in the news cycle, because eventually people are going to catch up with our thinking, I think. So if you're interested in maybe making investments in some of these sectors, do it now while everybody's panicking, and you get them at low prices. Clint, I'll talk to you next week.
Great. Thanks, Ted.